Now, what is better? Putting your money into your mortgage, paying down your debt, or investing in the share market? If you're lucky enough to come into a bit of extra money, or you've got some money left over at the end of each week and you want to put it somewhere, a lot of people wonder what is better. Now, sorry to disappoint you straight up, but I can't give you a definitive answer on that because the answer will be different for everyone. But what I can do is go through a few of the main points that you should consider when deciding which option is best for you. As a quick precursor, for the purposes of this video, when I'm talking about a mortgage, I'm talking about a mortgage on your primary residence, that is your home, and not an investment property. Now, when looking at whether to pay off your mortgage or invest, there can be different versions of which option is best for you. For instance, what is better mathematically? What is the interest rate? Where is inflation sitting? What is the expected return on investment in the share market? That sort of thing. What is better emotionally? Basically, what helps you sleep at night? And all in all, you want to go for what is a better balanced approach. So you want to do what's best for you investment-wise, but you want to do what you are essentially comfortable with. And which option you choose will ultimately come down to what your risk profile is, what your goals are, and what stage of life you're in. For instance, if you're quite conservative and you don't like taking on unnecessary risk, then you might look to pay down a good chunk of your mortgage first, so that you can relax having a low debt and then look to put some money into the share market. Paying down your mortgage is a guaranteed return. It holds zero risk. Every dollar you put towards it is a dollar that you won't be paying interest on, and that ultimately means more money in your pocket. It is also a tax-free benefit. Interest paid on a primary residence doesn't get a tax deduction, where interest paid on an investment property does. So essentially, a reduced interest payment is the same as interest income. A dollar saved is a dollar earned, as they say. It has the same effect on your personal profit and loss statement. So you get the benefit and you don't have to pay tax on that benefit. Further, it's hard to beat that feeling of security that will come from owning your home outright. No one can kick you out. As long as you keep paying your rates, it's yours and you're safe. And not having that large mortgage repayment come out every month will make a huge difference to your sense of financial well-being. It will give you the confidence to maybe quit your job or go to part-time with your job so you can start a new business. It'll give you confidence to take 6 months off or a year off, perhaps to travel. Whatever the circumstance might be, whatever you want to do, it expands your life choices. The basic point here is if you have a large debt and a large mortgage repayment, you have no choice but to have to go to work every day. You have to bring in that money week after week, month after month, year after year for 30 years. It's not going to pay itself off. But if that debt is paid down, all of a sudden you have this extra choice. You don't have to work as much if you don't want to because your basic living expenses are a lot lower. Now, getting into the what is better mathematically part, if you don't mind the volatility that comes with owning shares, the return on shares almost always, well, particularly now when interest rates are so low, is almost always better or higher than the interest rate you'd be paying on your mortgage. For example, at this point in time, interest rates in Australia are around 3%. You might be paying a bit lower than that if you're lucky, but let's say you're paying 3%. And you might be getting, say, a 6 to 8% return on the share market. Now, you can compare this 3% with a 6 to 8% in the way that when you pay money on your mortgage, that is money off the principal that you won't be paying interest on. So that is effectively a 3% return because it's 3% less than you're going to be paying otherwise. Now, when you compare that to, say, 6 to 8% in the share market, you're coming out in front. Of course, you're going to have to pay tax on your dividends and you're going to have to pay capital gains if you sell your shares. But still, the way things are sitting and have been sitting for quite a while in this country, you're likely to get a better return in the share market than you would by paying down your mortgage. And like having no debt, having a nice portfolio of shares, paying out nice fat divvies every quarter can also substantially open up your life choices. And I made a video about this, talking more about why dividends can be good to your lifestyle. And if you're interested in that, I'll put a link up the top and you can check that out. Another thing you might want to consider is the current macro environment, and more specifically, the monetary policy being set by central banks. Right now in 2021, our Reserve Bank, like many other central banks around the world, are printing money at rates that have never been seen before. And printing money, or quantitative easing as it's known these days, is basically a method of increasing the overall money supply in the economy. And something that any first year commerce student could tell you when they've gone through and done their macroeconomics 101 course is that when you increase the money supply, it generally flows through to higher prices for goods and services for the average consumer. This is because when the money supply increases, there is more money sloshing around in the whole economy. But if the total amount of goods and services has stayed about the same, it means there is more money moving around chasing the same amount of goods and services, so then prices go up. Or to put it very simply, increased money supply equals higher inflation. And if you have higher inflation, it usually means that in 10 to 20 years' time, that big mortgage of yours isn't going to look so big, because prices of everything else would have gone up, but your mortgage would have stayed the same and gone down a little bit if you are making your repayments and paying it off. So to sum that up, if interest rates are super low and inflation is on the increase, then you may take the stance that paying down debt that will in time be inflated away may not be a huge priority for you. And in this case, you may view investing in shares as the better option to paying down debt. But also, guys, usually higher inflation would prompt a central bank to start increasing interest rates to keep inflation in check. So you have to keep that in mind as well. But that said, we do live in crazy times where central bank policy and the markets don't always make sense. So who knows? Another perspective on this with having super low interest rates is that it could be a golden opportunity to really hit that mortgage hard to make a sizable dent in your principal. This is because as long as you maintain paying your repayments at a certain amount, you don't lower your repayments when interest rates drop, it means that each time you make a repayment, more of your money is going down to paying down the debt rather than going on interest. And over the long term, this will bring your debt down a lot faster. Now, earlier in the video, I mentioned that your stage in life could have some bearing on whether you choose to pay down your mortgage or invest in shares. For instance, just touching on this, if you were younger at an earlier stage in life, you may not be in so much of a hurry to pay off your mortgage. But if you're sort of getting up to sort of 50, 60, you're not too far for retirement, then you're probably going to be wanting to pay down your mortgage a lot quicker. You don't want to really be going into retirement when your income is probably going to drop a lot. You might be living on your super, you might be having a pension, you might have other investments, but in all likelihood, your income will be lower than what you're used to when you're working full time. And you don't want your now lower income to be going on a big mortgage payment each month. You want that money to be going into your lifestyle to enjoy your life. At the end of the day, there's no right or wrong answer. Everything is good for your wealth building process. Whether you're paying down debt, your net worth is going up. And if you're investing in shares, your net worth is going up. So it's all good. The main important thing is to give proper consideration around all these factors, the things we've spoken about in regards to your risk profile, your goals, and the stage of your life that you are in. And while, say, investing in shares may be mathematically superior in most cases, of course, nothing is guaranteed here with the market, but there's definitely nothing wrong with giving more weight to the emotional factors. You need to be able to sleep at night, you need to be happy with what you're doing, and you need to think about what is best for you at this point in time. And you know what, guys, it may not be easy, but if you can get into a position where you have no or low debt and you have a budding dividend portfolio pumping out dividends on a quarterly or semi-annual basis, that is the knockout combination. If you can get to that point, you are going to be laughing all the way to the Caribbean. This is the kind of setup that will give you massive freedom of choice. Whether you want to work, whether you don't want to work, whatever you want to do, you're going to have a lot more say in what you want to do and how you own your time. So that sounds pretty good, doesn't it? Anyway, guys, that's it for the video. Thanks for watching. If you, I don't know, even enjoyed it, or if you learned anything, please hit the like. If you want to see more, please subscribe. If you have any questions or you want to discuss anything, hit it up in the comment section down below. We can keep discussing the topic. I'd love to hear what your thoughts are, what you have done, and we'll see you in the next one.